Hi, this is Mike Burnick from Money and Markets TV. Since the global credit crunch began just a few years ago, investors have been searching for relative safety in the markets, and many thought to find it in U.S. Treasury bonds. The so-called flight to quality trade pushed the yield on the benchmark 10-year Treasury to a record low of 1.38% last month. But over the past couple of weeks, we've seen a big shift in the bond market. In fact, Bloomberg called it the biggest sell-off in Treasuries since 2010. With 10-year yields rising above 1.86% recently, although since then has dropped back a bit. So, could we be seeing the beginning of the end of the historic Treasury bond bubble? Well, you could make that argument, certainly. Maybe investors are finally starting to wonder if such low interest rates today are worth the risk of making a 10-year loan to Uncle Sam. In fact, if you subtract the current inflation rate of about 2%, which is itself historically low, investors are actually getting a negative real yield from owning 10-year Treasuries. And of course, calculating the after-tax and after-inflation return makes matters even worse. In other words, you're actually paying the government for the privilege of parking your money in the U.S. Treasury. Bonds have become a return-free investment, not a risk-free one. That's why even PIMCO's Bill Gross, the world's largest bond fund manager, recently warned that risk-averse investors looking to hide out in Treasuries will see a haircut relative to future inflation. I think that's probably putting it mildly. A scalping is more like it. Now, the bond bubble may not be bursting just yet. After all, we've seen temporary sell-offs before, only to watch interest rates sink even lower again. But I'm willing to bet that at some point soon, and probably when most investors are not expecting it, interest rates and inflation will start moving higher in a lasting upswing. When this happens, it's likely to be a swift and profitable move for investors positioned on the right side of the trade. Now, one way to get ahead of that curve is with the ProShares Short 20-plus year Treasury Exchange Traded Fund. The symbol is TBF. It's an extremely liquid inverse ETF designed to go up in price as long-term treasuries go down. And if you want to specifically target the benchmark 10-year Treasury, you should consider the iPath US Treasury 10-year Bear ETN. The symbol on this fund is DTYS. And if you want to maximize your profits from an increase in yields, you can use leveraged ETFs, such as the Direction 7 to 10-year Treasury Bear, symbol TYO. It's designed to rise 3% in value for every 1% decline in Treasury prices. So whether the great American bond bubble keeps unrolling along or is already losing some of its hot air, it pays to remember that with yields at such historic lows today, investing in Treasuries is far from risk-free. I'm Mike Burnick from Money and Markets TV. Thanks for watching and good investing.